We have like 18 students online. Please, Mr. White, can you mute? Jamil, can you mute your speaker? That was what we said. By the design of God, we have to take online class with this topic. We are looking at transfer pricing. What is transfer price? Why transfer pricing? Let me start by saying that this topic is related to divisional performance or company that is operated on divisional structure. We shall be discussing the meaning of transfer price, conditions for transfer pricing, objective of a good transfer price, then how do we determine transfer price? If time permits, we shall look at questions on this. All right, let's get to the business. Transfer pricing. Before we go into definition, let us do an overview of this topic. Now, where a company is operated along divisional structure, where a company is operated along divisional structure, it is very possible that one division will produce goods. One division will produce goods or service that is required by another division within the same organization. Let's take that again. Where a company is segmented along divisional structure, it is not impossible that one division will produce goods or service that is required by another division within the same organization. Definitely, the transactions between divisions must be valued. The transaction between divisions of a company must be priced. What is this price? This price is what we call transfer price. What is transfer price? Transfer price can be defined as the monetary value attached to goods and services that is exchanged between divisions of the same organization. Transfer price can be defined as the monetary value attached to goods and services exchanged between divisions of the same company. For example, we know Dangote, Dangote's groups. We have Dangote Sugar, we have Dangote Bakery, we have Dangote Foods. Let's take Dangote Sugar and Dangote Bread, Dangote Bakery. Please, Ruth, can you mute your speaker? Ruth, Christopher, please mute your speaker. Thank you. And please always check that your speaker. At times it might go unmuted. You need to go back and mute. All right. Let's take Dangote Sugar. If Dangote Sugar is selling sugar to Dangote Bakery, Dangote Sugar is a division under Dangote Groups. We also have Dangote Bakery. Now, if Dangote Sugar is selling sugar to Dangote Bakery, at what price will Dangote Sugar sell to Dangote Bakery? The price at which transactions are valued between divisions is what we call transfer price. It is the price for goods and services transferred from one division to another division of the same group. That is the definition of transfer price. Now, please note, the following should be noted when it comes to transfer pricing. The transfer price will create sales income for the selling division. Transfer price is the price for transaction between the selling division and the buying division. For the selling division, you are going to have sales value, internal sales value. To the buying division, you are going to have internal purchased cost. What is revenue to one division is cost to another division. That revenue and cost we cancel out when we get to the group's head office. From the company's perspective, internal transfer will not affect the company's profits. From the company's viewpoints, internal transfer will not affect the company's profit. Although the internal transfer will affect the divisional profits, will affect the individual divisional profits, but it will not affect the group's total profit. That should be noted. We have explained the meaning of transfer price. Next, conditions of a good transfer price. 1, the company must adopt a divisional structure. For you to talk of transfer price, then there must be divisions within the company. That is condition 1. Condition number 2, divisions must be autonomous in nature. That is, each division must be independent. Dangote Sugar is independent of Dangote Salt. Dangote Cement is an independent company. Chizoba, please can you mute? Plus admin, please can you mute? Number 3, the divisions must either be a profit center or investment center. A division cannot be a cost center. Number 4, one division must be manufacturing a component or sub-assembly which the other division will require. One division must manufacture a product that is required by the other division for the purpose of its final products. For example, Dangote Sugar manufactures sugar, and sugar is required to manufacture bread. If you are producing juice, Sugar is required to manufacture juice. Kayode, please, can you mute? You have to occasionally check your speaker, because when your speaker will go unmuted, you might not even know, and that will conflict the class. Then number 5, the management of the two divisions must be willing and ready to transact business with each other. Division A must be willing to transact business with Division B. Division B must be willing to transact business with Division A. These are the conditions for transfer pricing. Next discussion. Objectives or quality of good transfer price. What are the quality of a good transfer pricing? 1, performance evaluation. The transfer price must allow for performance evaluation. Number 2, autonomy. The transfer price must guarantee divisional independence. If you are setting a transfer price, you must not impair the independence of the division. Number 3, motivation. The transfer price should motivate the buying division and the selling division to be willing to transact business with themselves. There must be motivation. That is, a transfer price must not demotivate anybody. Please note that point. Transfer price should not demotivate divisional manager. Then number 4, go Congress. Transfer price must ensure or must promote go Congress. That is, the objective of a division should be in line with the objective of the corporate head office. That is what we refer to as go Congress. All right. We have explained the meaning of transfer price. We have looked at the conditions for transfer pricing. We have looked at the qualities or objective transfer price. Our next discussion is method of transfer pricing. Is that clear, please? Number 1 method, cost-based transfer price. Under this method, the relevant transfer price between the buying division and the selling division is based on the actual cost of production. Transfer based on cost. Under this method, the transfer price between the manufacturing division and the buying division be based on the cost of production. But this method may demotivate the selling division. That is, if it costs you 100 naira to produce a goods, they're not going to transfer at 100 naira. Cost-based method may demotivate the manufacturing division. If you look at the advantages, it eliminates complexity associated with stock valuation. The approach is not prone to market fluctuation. So the buyer will be happy. That is, to the buying division, you are buying at a cost, it will be happy. But if you look at its advantages, the cost-based methods do not allow for initiative in pricing. It may encourage suboptimality. It can affect independency of the division. The approach cannot be used for performance evaluation. If the corporate objective is based on profitability, then the method may negate goal congruence. That means the objective of the division is not the same with the objective of the corporate head office. But we can use cost-based method. Number 2, we have market-based transfer price. We have market-based transfer price. Under this method, the relevant transfer price between the selling division and the buying division is based on the prevailing market price at the external markets. Under this method, the relevant transfer price between the manufacturing division and the buying division will be based on the prevailing market price of the product. If you are talking of market-based transfer price, that means the products in question. The product in question has external markets. Customers are willing to buy this product outside. It also means that there's external market price. That external market price will be taken as the transfer price, the prevailing market price of the product. Now, please note, for you to talk of market base, you must have external market for your product. That external market is called intermediate market for the product. That external, please 1 minute. Let's continue. The external market is what we refer to as the intermediate market for the product or service. Now, this external market could be perfect external market or imperfect external markets, or you have what we call non-existent markets. We have to explain this very clear to us. You can have a perfect external market for your product. You can have a perfect external market for your product. or imperfect external market. Let us explain perfect external market. If it is possible for the company to sell all the outputs at the external markets fully at the prevailing market price, that is a perfect external market. I'll take that again. A perfect external market or a perfect intermediate market is a situation where it is possible for the manufacturer to sell all his products or his outputs fully at the external market at the prevailing market price. In that case, you have a perfect external market. For example, our company XYZ PSC, the maximum capacity of our company production, our company machine, the maximum capacity is 500,000 units. Now, if you produce 500,000 units and the price for per product or per unit is 1,000 naira, if it is possible for us to sell all our 500,000 units at the external market, that is to external buyers, all the 500 can be sold at 1,000 naira. That means we have a perfect external market. In this case, if you are required to transfer items internally to your division, in this case, if you are required to transfer some of these items internally to other division within your group, within your company, let's assume out of 500,000, we are required to transfer 50,000 to another division. If you are transferring to another division, that 50,000 will be transferred at the market price. Whether you sell internally or you sell externally, you are going to sell at the market price because there is a perfect external market or perfect intermediate market. That is external, that is perfect external market situation. Imperfect external market or imperfect intermediate market. Let us explain that. When we say imperfect intermediate market, it means the company has external market for its products. However, the company cannot sell all the output fully at the external market. The company has external markets for its products, but cannot sell all the output fully at the external market at the prevailing market price. In this case, we have imperfect external market situation or imperfect intermediate market. For example, our company again, the maximum capacity is 500,000 units we can produce. But we can only sell 400,000 units. We can only sell externally 400,000 units. That balance of 100,000 units is referred to as spare capacity. That balance of 100 units is referred to as spare capacity. Because you cannot sell these items at the external market, nobody is willing to buy. That excess is referred to as what? Spare capacity or excess capacity. Now, that excess capacity, if you are going to transfer that balance to other division within your group, if you are to transfer the spare capacity internally to another division, you are going to transfer at the marginal cost of production. That balance should be transferred as the variable cost of manufacture. The spare capacity should be transferred at variable cost of manufacture. Although that variable cost may demotivate the selling division. That means you manufacture a product for 100 naira, variable cost. To manufacture your product, the variable cost is 100 naira. And normally you sell your product for 200 naira. Now you have produced these products. You produce 500,000. In getting to the market, you can only sell 400,000. You now want to transfer the balance internally. That balance, you now transfer at your variable cost of manufacture. That would be the transfer price. Now the question is, why variable cost? Your variable cost is your relevant cost. That is one. Relevant cost the company has incurred. Relevant cost the division has incurred to manufacture the products. Why are we taking cost? Because the other division is doing you a favor by buying. Instead of you incurring cost, we are buying from you instead of you incurring loss, because no customer is willing to buy the product from you outside. Instead of incurring loss, we are now trying to buy from you at your cost of production. At least if you cannot make loss, if you cannot make profit, you must not suffer loss. That is the concept behind variable manufacturing cost. Like I said, it may demotivate the manufacturing division. Then the third one is non-existence. It simply means that there is no external market for that product. When we say non-existent, it simply means that there is no external market for the product. Once that product is produced, it must be transferred to other division. In that case, that division, we only incur cost, and that will not be a division. If you look at Mercedes-Benz, that Mercedes-Benz door is produced by one of the division, that door can only fit Mercedes-Benz. You cannot take Mercedes-Benz door to another car. It won't work. So there is no external market for that product. You can only manufacture the door and transfer it to another division to complete the production of car. To complete the production of Mercedes-Benz car. That door cannot be sold to another motor company. That means there is no external market for that component. Note, when you get to market price, you can take market price or market price less cost savings. Cost savings in packaging, distribution costs, or selling costs. What we are trying to say is, if I'm transferring goods internally, I don't need to, we are the same division now. Okay. If Dangote Sugar want to transfer sugar to Dangote Salt, to Dangote Bakery, they don't need to package the sugar in a nylon. They just say, okay, if it's to bake bread, they just okay, let us just measure the sugar required. Maybe 1 drum of sugar. They will just take it to Dangote Bakery without incurring the cost of packaging. Like that, bagging it now. You don't need to incur cost of a package. In this case, you can transfer at market price, less cost of package, because you didn't package for your internal customer. Your internal customer is divisions within your company. You don't need to incur packaging costs. All right. Advantage of this method, market-based, of course, this will enhance performance evaluation. It encourages initiative. It guarantees divisional autonomy. It is used to maximize company's profits. Of course, it will motivate both the buyer and the seller. I'm selling to you. That means if I'm selling, the same price I will sell to external customer, I will also sell to you as my internal customer. So whether I sell outside, I can either make my profit from outside or from within. It doesn't matter who I sell to. Limitation of market-based transfer price. It is prone to market fluctuations. Market price can change at any time. At times, market-based transfer price may lead to unhealthy rivalry among divisional managers. The method could be cumbersome because it can create unrealized profit on stock. Then this method is not consistent with historical accounting reporting system. Your accounting system is based on a historical method. We are now looking at it from market-based method now. We have explained two. We have explained cost-based transfer price. We have explained market-based transfer price. Number 3 is negotiated transfer price. That is transfer price based on agreement between the selling division and the buying divisional manager after negotiation. The buying division and the selling division, they will negotiate the transfer price. I want to buy sugar from you. Maybe I'm the head of I'm the head of Dangote Bakery. Now you are the head of Dangote Sugar. I want to purchase sugar from you. You want to sell sugar to me. We work in the same company, but different divisions. We can negotiate the price between the buyer and the seller. That is negotiated transfer price. Of course, the transfer price will motivate both managers. It can guarantee additional autonomy. It is not prone to market fluctuations because two of us will agree. It encourages initiative. Limitation of this method. It is time consuming. Number two, a domineering manager may sacrifice long-term corporate objective for personal or divisional gain. Now, when you are discussing some people, they are very domineering. It is their own points. They will never, even if it is only their own point they must look at. The approach may encourage suboptimality because it can be used to conceive inefficiency. Then we have transfer price. We have arbitrary transfer price. We have arbitrary transfer price. This is the transfer price determined by the central management, that is the central head office. With or without the consent of the divisional managers. Arbitrary transfer price is a transfer price determined by the corporate head office. Usually where there's argument between the managers, the corporate head office can say, okay, transfer at this price. Shebi is our business. You are not the owner of the company. So the group MD can give instruction that, okay, the selling division transfer at this price, and you must buy at this price. Advantages. It can guarantee or it can promote go congress. The head office will determine based on company's objective. It is not prone to market fluctuation. It can be considered for planning purposes. This will eliminate unusual time being wasted on negotiation. Limitation of or disadvantages of arbitrary transfer price. The method may encourage unhealthy rivalry. Definitely, this method will discourage initiative, and it will affect divisional independence. This method is not motivational. Lastly, we have transfer price based on opportunity cost. You can determine transfer price based on opportunity cost. In this case, when we say transfer price based on opportunity cost, in this case, you have two things to determine, to use. The transfer price based on opportunity cost is equal to the variable cost of production plus the opportunity cost to the company of supplying the product internally. If you are required to calculate transfer price based on opportunity cost, you require two variables. If you are required to determine transfer price based on opportunity cost, you require two variables. One is your variable cost of manufacture plus the opportunity cost to the organization as a whole for supplying the product internally. Of course, if I'm supplying the product internally, the opportunity cost is the contribution loss, contribution foregone from the external sales. Assuming I have sold this good externally, what is the contribution I will have generated? Your opportunity cost is the contribution foregone from the external sales. Please note, transfer price based on opportunity cost will still return back to market-based transfer price. You are still going to derive the market price. So don't be surprised if the answer says calculate transfer price based on opportunity cost. Your answer will return back to the market price of the product. Is that clear, please? Lastly, identifying the optimal transfer price, or what we call ID transfer price. How do we identify an optimum transfer price? That is the best transfer price or the ID transfer price. The following rules should help you to identify ID transfer price in any situation. Please, please, you might need to memorize these rules. These three rules, you might need to internalize it. Meaning you should be able to understand this and reproduce this when required. Rule number one, begin by identifying the arrangements. Rule number one, start or begin by identifying the arrangements for transferring goods internally that will maximize the profit of the company as a whole. The first rule is that you are going to identify the arrangement for transferring goods internally that will maximize the profit of the company. In other words, what solution is best for the company? Please note, the only time the company will make money is when you are making external sales. Please note, the only time the company will make money is when there's external sales. Rule number two, having identified the plan that is in the best interest of the company as a whole, identify the transfer price or range of transfer prices that will make the manager of the buying division, that will motivate the manager of the buying division to be willing to work towards this plan. You must identify transfer price or prices that will motivate the buying division to be willing to buy internally. You can ask ourselves, for me to buy internally, the internal price must not exceed the external price. If the product is sold for 1,000 naira outside, and you are telling me to buy for 1,500 inside, I say, no, I can buy this product outside for 1,000 naira now. So, for the buying division to be motivated to buy the products internally, the transfer price must not exceed what the external supplier is offering us. Then rule number 3. In the same way, having identified the plan that is in the best interest of the company as a whole, having identified the plan that is in the best interest of the company as a whole, identify the transfer price or range of transfer prices that will motivate the manager of the selling division to be willing to work towards the same plan. What that means is, for the selling division to be willing to sell internally, then the price at which we are selling internally must not be lower than the price we want to sell externally. If I can sell my product at the external market for 800, and you are telling me to sell to you internal customer for 700, I will not be motivated to sell to you. I can sell the product for 800 naira outside. You are not saying I should sell to you for 700. So I will not be motivated. So if I want to sell to you, I would prefer to sell to you at 800 naira. That means if I sell outside, 800. If I sell within, 800. So what's my business? Anyway I'm selling, I will make my profits. So these 3 rules, we have to take it in. Is that clear, please? Jennifer. The Black Moses. All right, we are done with the explanation. Any question? Now let's take this later. This one is about international transfer pricing. Let me just brief this. Okay, let me brief this. International transfer pricing. It's very possible that one division is in different country now. The same company with different division at different countries now. That is what we refer to as international transfer pricing. Transfer within international group. We often involve cross-border. What are the issues here? It's like saying we have Dangote Nigeria. We also have Dangote Ghana. Dangote Nigeria, of course, both divisions belong to the same company. Now, if Dangote Sugar in Nigeria is transferring sugar to Dangote Bakery in Ghana, we have different currencies. The account of Dangote Sugar, Dangote Nigerian Sugar, will be denominated in Naira, while the account of Dangote Bakery, Ghana, will be denominated in cedis. That means there's differences in currency. There could also be differences in tax. The tax rate in Nigeria is different from the tax rate in Ghana. Multinational company can use transfer pricing to reduce tax liability. Multinational companies can use transfer pricing to evade tax, although it's not easy, because tax authority we know. Every other thing is just noise now. When it gets to international transfer pricing, we are interested in the taxation, currency swap. For this level, you cannot do currency swap, like currency exchange. The only thing you can test is taxation at this level. All right. The first 1 hour is gone. Any question, please? Oh, let me check, sir. Now the question says, am I going to give you these notes? The note has been shared with you now. This material was shared on Friday or Thursday morning. So I've shared this material before now. This material was shared with you, not today. Am I going to detect? We can't detect online now. The material is with you, Mr. Moses.
Hello, sir.
Yeah.
Yeah, Ahmed on the line. The material shared, most part of it are not complete like what we have on the screen now.
Really?
Yes, even I've been having that problem. The last material sent and this particular topic to the same thing. Maybe when we meet last business coming Sunday, I will.
Are you saying this material is different from what you have?
It's not complete. Most part of it have been cut off.
Why will it cut off?
I don't know. Is a different thing entirely from what
I'm checking my system because that's what I have here. I'm checking what I share with you.
I will show it to you on Sunday when we meet next Sunday.
No, most I will share with me. Let me check.
Okay, or maybe you help us reshare it.
No, even now.
The same thing applicable to the fictional performance evaluation.
Please hold on, Ahmed.
Yes, sir.
The material Moses shared contain everything I explained here.
I don't know where the problem
Please,
is.
we know what I'm trying to say. You hold on. You have made a serious case. A student has shared the same material that contains what we have discussed. There's nothing different here. Okay, please, can somebody else confirm this?
I will recheck, sir.
Hello, sir.
Yes.
So this one is not the one that was shared on the group. The physical material that we have too is not comprehensive. What you just gave us now is totally different from what is in the hard copy material.
Please hold on. I never gave you a copy. This class was designed to run with soft copy. Are you there, please? This class originally was designed to run with soft copy. So, first of all, leave that hard copy first. But the material I shared on that Thursday, this same material is shared by Moses. It contains everything I've explained. That is why every lecture I have, I don't look at your hard copy. I share the material to the student again. Because at the start of this class, what we wanted to do is to run without hard copy. And I'm aware that some students does not have software hard copy. They don't pay for hard copy. It will be wrong for me to say because some people have paid for hard copy, I will now stop giving you soft copy. That's why if you look at it, all the lectures, we still produce the soft copy. So the soft copy I shared, that should be on Friday or Thursday, I'm not sure now. Because that is what I use for this explanation. And interestingly, Moses just shared that same soft copy with a group. It contains everything I explained. Somebody else has shared this copy again. Let me look at what this person is sharing. So, Mr. Ahmed, I only have one material shared on transfer pricing. The same material I've used for this class. 2 students have also reshared this material. So I do not know the source of your own material cutting now.
Let's proceed, sir.
So for that hard copy, I'm not saying don't get it, but for me, that hard copy was what we used last diet. And at the start of this class, we were to use soft copy. So if I see something that I believe will benefit the students, I'm going to add it to the soft copy. You have gotten the hard copy, you also have the soft copy. So if anything is not in your hard copy printing, you can look at it from the soft copy to augment your hard copy. I don't have problem with your hard copy you are using. But I'm just saying that the communication we have when this class was starting is that we are going to use soft copy to run the class. So please forgive us if the hard copy you have is not having some of these things. Book is not supposed to be stagnant. That's where I'm going. Book must be reviewed to accommodate what we call improvement. Okay. Any question? Any question, please? If there is no question, me, I must have question for you. But I need to bring in some. Okay, we manage it. Like this question, now this you have 3 zeros. This you have 3 zeros. This is in thousands. All right, let's look at question number 2. Let us take question number 2. Question 2. I'll still read because I want to manage this 1 hour. All right, let's go to question number 2. Of course, it's also available in your, this question number 2 is available in your hard copy. I think check question 7 or 6. Your hard copy, question 6, Abby? Aha.
Yes.
It's available there. It's there. Now let's take this question together. Abuja Industries has several independent divisions. The company's tube division manufactures a picture tube used in television sets. The tube division absorption costing income statement for last year, in which 8,000 tubes were sold. Please note the number of tubes produced and sold. 8,000 were sold, is given below. Sales value 27,200 million. Selling price per unit is also given. Cost of sales, total amount 16.8 million. Cost of sales per unit 2,100. Selling expenses, profits given. Divisional net operating profits given. Next note. As shown above, it cost the tube division 2,100 to purchase a single tube. This figure consists of the following: direct material cost 760, direct labor cost per unit 540, production overhead in bracket 75% fixed is 800. Now then total is 2,100. Please note, examiner says production overhead in bracket fixed is 75%. It means that the variable aspect is 25%, because the total cost will be 100%. If 75% is fixed, it means that 25% is the variable element. As you read question, you must be able to interpret what we call some unseen. There are some information that is hidden. You need to bring it out. The examiner says fixed cost is 75%. That means variable cost is 25%. Because total cost must equal to 100%. Let's continue. The tube division has fixed selling and admin expenses of 7 million per annum per year. Benue Industry, please remove this. Abuja Industry. The name is Abuja, not Benue. An error. Abuja Industries has just formed, not informed, has just formed a new division called Television Division that we assemble a television set requiring a high resolution picture tubes. That means this company called Abuja Industry has formed a new division called Television Division. This division will manufacture television. The television will require a high resolution picture tubes. The tube division has been asked to manufacture 2,500 of these tubes each year and sell them to television division. That means tube division will manufacture tubes and sell the tubes to television division. The two divisions are under the same company, Abuja Industries. To sell to television as one step in determining the price that should be charged to the TV division. The tube division has estimated high resolution tubes. That is, of course, this tube is different from the regular tubes. High resolution tubes. To manufacture this, material cost is 1,200. Labor cost is 980. Production overhead, total is 1,080. That now says 2/3 is fixed. What is variable? If 2/3 is fixed, what is variable? Anybody?
Is 360.
Variable is 1/3.
1/3 is 360. 360 is 1/3.
You are both correct. Variable is just 1/3. So total cost per tube, per new resolution tube, 3,260. Now look at this paragraph. Look at this paragraph, please. To manufacture the new tubes, the tube division will have to reduce production of its regular tubes by 3,000 units per annum. Let us interpret that. To manufacture the new tubes now, tube division must reduce production of regular tubes. That is opportunity cost. Is that not, please? If I want to manufacture new tubes, then I'm going to sacrifice manufacturing of regular tubes by 3,000. That is opportunity cost. Alternative foregone. Okay. There will be no variable selling and admin expenses on the intercompany business, and total fixed overhead cost will not change. Assume direct labor is a variable cost. Requirement A. Determine the lowest acceptable transfer price from the perspective of the tube division for each of the new high resolution tubes. Price per unit of resolution tubes. Requirement 1 is for 12 marks. Requirement 2 is for 3 marks. How do we deal with this? How do we deal with this question? First is, I need to understand what I'm going to do. I must understand what I need to do. Tube division will manufacture tubes and transfer to television division. What price should be the minimum? What should be the minimum transfer price? My minimum transfer price should be my cost of production. That means if I'm not making profits, I must not incur loss. The minimum transfer price should be the cost of producing, relevant cost of producing the new high resolution tube. That is the minimum cost. That is the minimum price I'm going to charge. My minimum price should be my cost. That is, if I'm not going to make profits, I should not incur loss. I will now look for the relevant cost of manufacturing new resolution tubes. I'm going to look for the cost relevant cost of manufacture a new high resolution tube now. In addition to the cost, I have opportunity cost here. For me to manufacture these new tubes, I'm going to sacrifice manufacturing of 3,000 units of regular tubes. Opportunity cost is relevant to decision making. Is that not, please? Hello?
Yes, sir.
Yes, it is. Yes, sir.
Yes, sir.
So let us go to the classroom now. Where are we meeting? VI or online? It can only be online now. Can't be VI. Please confirm you can see my whiteboard being shared.
Yes, sir.
Sir.
Let us start this solution now.
Confirm, sir.
Let us start solution now. Please get your calculator near you. My first working, that is working one. I want to get the relevant cost, relevant cost of new tubes, new tube. I'll have the direct material cost. Material cost is relevant. What is the material cost per unit of new tube? Look at the question and tell us. How much?
$1,200.
Okay, please, so I won't be sharing, I will just minimize this. This is 1,200. I'll pick that. Labor cost is a variable cost. It's also relevant. What is the labor cost for new tubes per unit? How much?
980.
980. Then I'm going to take the variable production cost. Is fixed cost relevant?
No.
No.
Variable production overhead.
360.
Overhead.
1/3 of
OH. 1/3 of, look at it, 2/3 is fixed. That means 1/3 is variable. 1/3 multiplied by 1,080. What do you have?
360, sir.
360.
Thank you. 360. You can now sum up. Please sum up.
2,540.
2,540.
2,540. We now need to introduce the opportunity cost. Opportunity cost now. Opportunity. The opportunity cost now. Let's go to that now. Back to the question. To manufacture the new tubes, the tube division will have to reduce production of its regular tubes by 3,000 units per annum. That means if you reduce production by 3,000 units per annum, that means we are going to lose, there's going to be contribution lost. Is that not? Our sales will be reduced by 3,000 units for the regular tubes. That means we are going to lose that contribution. The opportunity cost is the contribution lost now. Is that clear, please?
Yes, sir.
For me to manufacture new tubes, I'm going to sacrifice 3,000 regular tubes. That means contribution will be lost. The opportunity cost is the contribution lost. I will now go and calculate contribution per unit of regular tubes. Look at it, please. For regular tubes, look at it. The selling price per unit is 3,400. I will now look for the variable cost. For regular tube, we have variable cost. Material cost 760. Labor cost 540. Production overhead, I'll take variable. Is that clear, please?
Yes, sir.
Okay, let's come here.
Okay, note on the side.
I will come to the second slide. I'm going to change the ink now.
No problem,
I
sir.
want to calculate for the regular tubes now. Regular tubes, that is the existing tubes. The selling price per unit for regular tubes, the selling price is 3,400. Is that not, please? Let me check.
3,400.
Oh, 3,400.
Yes.
3,400.
I will now look for the variable cost of the regular tubes. Variable costs. We have
2,540.
direct material. How much?
760.
760.
Direct labor.
Direct labor. How much?
540.
540. I will pick variable production overhead.
25%.
I'm going to shorten variable production. I will have to shorten this. Overhead. 25%, Abi, of how much?
Yes.
Of 800.
That's 200.
Of 800.
That's 200.
That will give us 200. Now, we cannot close this. We still have variable selling now. It's hidden, but you need to bring it out. Please look at this, please. Selling and admin, examiner say is equal to 7,800,000. Total selling and admin is equal to 7,800,000. Now come here, look at the notes. The note says the tube division has fixed selling and admin expenses, 7 million naira. That means out of 7.8 million, the fixed selling and admin expenses is 7 million. It means that the balance is variable selling and admin expenses. Is that clear, please?
Yes. Yes, sir.
We now come here and do like this. We can move down small. I'll do like this. Total selling and admin. I will shorten this, please, because of space. is equal to 7,800,000.
Yeah.
But our fixed selling,
7 million.
fixed selling is 7 million.
Where is 800? 800.
That means variable selling. Look at it. Variable selling expenses is 800,000. This is 800,000. But I want to know variable selling per unit. How many tools do we produce that year? Let's go to it.
It's
Look at it.
8,000.
Thank you. But I need to show it because some might not know. Look at it. Examiner says the tube division absorption costing income statement for last year, in which 8,000 tubes were sold. That means we produced 8,000 tubes. And we sold 8,000 tubes. The total selling overhead is 800,000. What is selling cost per unit? Just 1 minute.
100. It's 100.
Thank you. We come here and say
100.
our selling cost per unit. I'm coming, please. Jennifer, please hold on. I'll come here and say, where's my mouse? Where's this? Is it sure? You'll be looking for this thing. Okay, it's here now. Variable selling is equal to 100. That is, if I want to get this out, maybe I will go to the next page. Let me show it here because I don't want how we got it. Jennifer, please hold on. I will attend to your request. Is equal to this is equal to the variable selling is equal to variable selling. This is variable selling and admin is equal to 800,000 divided by 8,000 units. This give me 100. So in case, okay, now you can ask your question, Jennifer.
Okay, sir. Good morning.
Yeah, morning.
He said, in this question, they said there will be no variable selling and administrative expenses on the intercompany business. Since they said there will be no selling and administrative expenses, why are we now calculating the variable selling?
Thank you. The question says no variable selling. It's for the new resolution. Look at the new resolution, please. I'm trying to take this up. Relevant cost of new tubes. Direct material, I pick. Direct labor, I pick. Very production, I pick. For the new resolution, for this new resolution, we don't have variable selling. But the variable selling we have computed is for the what? Is for the regular tube that has been produced before. We are trying to get contribution for the regular tube. Is that clear, please?
Yes.
Jennifer, is that clear, please?
Yes, sir.
So the selling price we are calculating is not for the new tubes. It is for the existing tubes. We are trying to look at the contribution from the existing tubes. That one has been produced last year. We have incurred variable selling last year. You want to know the contribution per unit from that one now. Is that clear, please? All right, we can come back here now. Please, let me take this, let me correct this one here. We have a mark here that can create problem. Okay, I can come back now. So this is 100. You can add all your variable costs together now. 760, 540, 200. What do you have? Total variable cost, how much?
1,600.
One what?
1,600.
1,600.
1,600.
We can now get our contribution per unit.
1,800.
Contribution for the regular
1,800.
Thank you. 1,800. That means for that 3,000 lost, contribution loss per unit is 1,800 per unit. Look at it. The company is going to reduce production by 3,000. That means total contribution loss. Now, Abby, look at it. The contribution loss per unit is 1,800. I will not say, okay, total contribution loss for the whole 3,000. I will go to working but 2. Look at it.
In this class.
Let's just forgive the person. No? He's not even aware. Just come here. I can go to next working, maybe working 2 or 3. I will not come here. Total contribution loss. 3,000 units multiplied by 1,800. How much, please?
5,400,000.
That is 5,400,000. This question is actually tricky, so if you pick 1/8 straight, you will not be correct. Now look at, for our new resolution, how many are we going to produce?
5,400,000.
Look at it here.
2,500.
The tube division has been asked to manufacture 2,000 tubes, Abby? 2,500 tubes, Abby?
Yes.
So it's not 3,000, Abby. So now come here. Contribution loss per unit of tubes produced. Look at it now. You can actually very tricky, a bit tricky issue. I will not come here. Look at it, please. Where's my cursor? Contribution loss per unit. Per unit of new tube. New tube, sorry, per unit of new tube. New tube is equal to 5,400,000 divided by the number of new tubes. Number of
2,500.
new tube is 2,500.
2,500. Yes.
That will now give us how much?
2,160.
2,160.
2,000. That is the contribution loss per new tube. 1,800 is contribution loss per old tube. But what I needed is contribution loss per new tube. I can now go and complete my solution now in first part. I can go to the first part. The first part of the solution. I can come here. Opportunity loss now. I'll just come here. I want to take opportunity loss. That is the contribution loss now. That's the opportunity cost. The opportunity loss. No, let me take black. That is document contribution loss is equal to 2,160. Therefore, minimum transfer price, add the two together. Transfer price, TR.
4,700.
700. That is the minimum transfer price tube division must charge for the new resolution tubes. That is the minimum transfer price the tube division must charge. That is the minimum. Anything below this, the company will incur loss. And that is your 12 marks. Please, carefully study this thing. Oh. It is not impossible that some of these questions will be in your exam. Oh. We are done with the A part of the question. Any question, please?
Sir, please, can you go to the other page of the working 3?
Why not? I can go there now.
Thank you.
What are you looking at the other page? What do you want there? Okay, I'm going there. Don't worry. I'm just pulling your leg. Nobody say, please come again. Please don't clean the board. Nothing like that here. Those Jennifer, they used to worry me in class. And yeah, you can go on break. You can go on break. The class will continue.
That's why they are ahead of us, sir.
But not really. Oh. It's just because they have not even started this. So we are still doing divisional performance with them.
Okay, sir.
The next page, Abby.
Yes, sir. Thank you.
Now, but I will still share. It's true now. And that lady, I don't even know her name. Once it's 1 o'clock, just go out. Where it's break time.
Sunshine.
All right, let's go to the B part of it.
Jessica.
Yeah, don't mind the 3 of them. Those 3 ladies in the front. So yeah, she needs to calm down now, calm down. All right, the B part says, assume that the television division have found an outside supplier that will provide the new tubes for 4,000 naira each. If the tube division meets this price, what will be the effect on the profit of the organization? Let's try to explain the question. Assume that the television division has found a supplier outside willing to supply the tube for 4,000 naira each.
Yes.
What we are supplying as 4,700. Somebody now says going to supply to you as 4,000 naira. What are we going to lose? If we are to meet this, if the tube division were to meet this price, what will be the effect on the profit of the organization? That means if the tube division guy decided to agree to supply to transfer at 4,000 naira, the company will be losing 700 naira per unit of tubes.
Per unit. They will be running at loss.
That's what I'm saying. So that means that what we produce for, what is going to cost us 4,700 to produce, we are now transferring at 4,000. That means 700 naira will be lost per tube the supply. And we are going to supply 2,000, we are going to produce 2,500 tubes.
So we multiply
by 700 multiplied by 2.5. The total profit. Yes. If you are to go to the workings now, if you go to the working now for that B part, well, let me check if I can manage here. No, let's go to whiteboard. Another whiteboard. Can come here and do like this. For the B part, B, the company's profits will fall by, look at it, minimum transfer price should be 4,700. That is the minimum cost of production, because we have fashion need contribution loss. Okay. Suppliers quotation. Suppliers quotation 4,000. Then a difference 700. Total profits lost is equal to 2,500 units tubes multiplied by 700. How much?
That's 1,750,000.
1,750.
The profit of the company will reach by 1,750,000 if tube division agrees to supply at 4,000 naira. That is your 3 marks. But you are going to put the comments. The profits of the company will reduce by 1,750,000 naira if tube division agree to meet the price of. Are you writing it? It's recorded. Yes. Now you are going to get it.
I'm writing it, sir.
Okay. The profits of the company will reduce by 1,750,000 if subdivision agree to meet the price of 4,000 naira per tube, that will give you your 15 marks. Any question, please?
Sir, please recap the last statement, sir, please. The company's profits will reduce by 1.7 million if the two divisions agree.
If tube division, if the tube division agrees to meet the price of 4,000 naira, to meet the price of 4,000 naira per tube. Is that better, sir?
Yes, sir.
Yes, sir.
Okay. We have 15 minutes, but there's no break. You can always take a break while you're in the classroom. Is that not? Let us look at one more question. Jennifer. It's true now. You can be taking your snacks while you're in the system. So.
Online serving.
Let's look at question 3. Question number 3. It's also in your hard copy printout. So, Garki PSC. Check the question. I think question. I'm not sure. Maybe second.
It's 2. It's number 2.
Number 2.
Question 2, Abia.
Yes, question 2.
Garki PSC is a holding company with 4 divisions, including Alba and Beta divisions. Alba division produces a component that is sold externally and can also transfer to other divisions within the group. That means Alba can sell externally, it can also sell internally. Beta division uses the component from Alba division as a raw material for its final products. The division can also obtain components from external suppliers. The components, when obtained from Alba division, undergo further processing at a cost of 4.50 naira per unit before it is sold to the external market. The board of directors, in order to implement a new appraisal review, has set up a performance scheme for the divisional managers. A performance target for the next financial year has been set, and the following budgeted information relating to the 2 divisions are prepared. Division, Alba division, Beta division, maximum production and sales. The capacity of Alba division is 900,000 units. Sales to external customers, 700,000 units. It means that 200,000 will be sold internally. External sales customer 700, internal sales should be 200. The selling price is 6.80 naira for Alba. Variable cost of Alba is 4.90 naira. The fixed cost 160,000. Capital employed, we have it. Residual income target. That means Aba division must achieve residual income of 700,000. While Beta must achieve residual income of 500,000. We are giving the additional cost of capital. Beta division has asked Aba division to quote a transfer price for the units of the components. Requirement A, calculate the transfer price per unit, which should be Aba, not Alpha. Examiner has been using Aba now. Please, for consistency, just calculate the transfer price, which Aba division should quote to Beta division in order that its budgeted residual income target will be achieved. If you look at this question, the transfer price must meet a specific target. That is more like arbitrary transfer price. Your transfer price must achieve a specific target. And the target is you must meet 700,000 naira residual income for Aba division. So what transfer price should Aba quote if it's to meet its residual income target? Remember that transfer price is the internal selling price or the internal purchase price. Look at it. The external price, selling price for the product is 6 naira 80 kobo. What calculate is now the internal selling price for division Aba. You know, when you understand a question and you're able to understand the requirement, then it is much easier for you to navigate your way to solution. What we are trying to calculate now is what is the internal selling price? What is the price for the quantity sold internally to internal customers? All right, let's go to this. All right, we have opened a new whiteboard for this question. In case you are not seeing it, please speak out. First, how do we compute residual income? I'm asking a question to the class. The question is on GAAP KPSC.
Profits minus capital employed times cost of capital.
That's great. So I'll go like this. Look at it. Now I have residual income. I'm giving the capital employed, and I'm giving the cost of capital. That means I can walk back to the profit now. Is that not? Look at it, please. I know my residual income. I know capital employed. I know cost of capital. I can do a walk back to get my profit. Is that not, please?
Yes.
We can do a walk back. Let's go to this question. Look at this. I can do like this. For I'm dealing with Aba division now. Aba division. I'll come here. I will start with my residual income. I want to shorten this, please. Residual income is 700,000. I will now come here. My notional interest, that is, this is your capital, notional interest is your capital employed. Capital employed multiplied by cost of capital. For division ABA, capital employed is 4 million. Is that not?
Yes, sir. Yes.
That's correct, sir.
Auto capital is 12%. Please,
Yes, sir.
compute. What do you have?
480,000.
480. If you add 480 to 700, that will give us our profits. The profit.
1,180,000.
Thank you. 1,180,000. That means the profit of division of ABA division must equal to 1,180,000. If you want to meet your residual income targets, ABA division must be able to achieve a profit equal to 1,180,000. We are getting the profit. Now we are working back now. You want to get the total sales value. For the, when we say total sales value, external sales value plus internal sales value. We want to get total sales value. It's like working back now. I've gotten my profit. I'll just come here and add divisional fixed cost. Divisional fixed cost. If you look at the question, the fixed cost of ABA division is 160, Abby.
160, yeah.
Add back.
1,000.
Are we adding or subtracting?
You can subtract to add back. What do you have? 1,000.
1,340,000.
3 what?
340.
If you add back fixed cost to profit, that will give you what?
Contribution, yes.
If you add back your fixed cost to your profit, that will give you your contribution. Because contribution minus fixed cost will give me the profits.
Profits. Okay.
If I want to get contribution, I'll just say profit plus fixed cost will give me my contribution. Then
Yes.
I will now add back my variable costs. This is my contribution. My variable costs. Variable cost. If you look at ABA division, ABA will produce 900,000 units. Maximum production, 900,000 units. Variable cost per unit, 4.90 naira. Please compute total variable cost for ABA.
4,410,000.
900,000 multiplied by 4.9. That gives you 4,410,000. 410,000. Your variable cost plus contribution will give you what?
5,750,000.
That is your sales value. 5,750,000. The total sales value of division ABA, total sales value is Total sales value is 5,750,000. Now, let me write that in full. Your sales value can be divided into two. We have for the other division, you have external sales and internal sales. Your total sales is 5,750,000. Your external sales now, because I want to know the external sales, I can now take external sales. Let's look at it. Go back to the question. Sales to external customer, how many units?
700. 200.
No.
700,000.
700.
700,000
Yes.
units.
500.
Internal 200.
Thank you. The selling
500.
price for external sales is 6 naira 80 kobo. Please, 700 multiplied by 6.8. What do you have?
4,760,000. 760,000.
760,000. You can show the working here. External sales is equal to 700 units multiplied by 6.8. That gives us 4,760,000. What is internal sales value? Difference between the two.
Remove 4,760,000.
It's two.
That is
Minus
200,000.
what is internal sales? Just look for the difference. Total sales value is 5,750,000. Less external sales. That will give you your internal sales.
990,000.
990.
990.
Internal sales value is 990. That is the internal sales value. And we are going to sell 200,000 units externally. Internally, is that not?
Yes, sir.
Who is this glory that is marking this here on my screen?
So, Ashiwaju, I don't know how you got the 990. Please, can you recap on that?
It's just minus. Total sales
Sir,
value
can
is
we
5,750,000.
get the recording of this class? Yes, sir. When you are done, sir.
That is normal now.
Okay.
Total
5
sales
million.
value is 5,750,000.
All right, sir.
External sales is 4,760,000. The difference between the two will give you your internal sales value.
All right, okay.
Is
I'm
that
getting
clear,
that.
please?
Clear, sir.
Now,
Thank
the
you.
internal sales value is 990. And you are going to sell 200,000 units internally. What is selling price per unit for internal sales?
4.95.
You just come here, look at the workings. Look at the workings. Internal selling price. Internal selling price is equal to total internal sales value.
990.
990 divided by quantity sold internally.
200,000.
100,000 units. This will give us how much?
4.95.
4.95. Therefore, the transfer price to achieve a target residual income is this amount. You are done with it. You are done with requirements A.
I'm sorry, sir. I have a question, please.
Please go ahead.
How did we get the 200,000?
Oh God, man, come and look at the question. No, that's when I'm reading question. I also explain. Maximum production of ABBA division, 900,000. Sales to external customer, 700,000. What is sales to internal customer?
Oh, okay. Thank you. I've gotten it's
And
200.
it's fine. So because some may not ask, they will just, I don't even know. You know, as you read question, there's what we call some hidden information you need to bring out yourself. If ABBA produces or produced on 900,000 units and is sold 700,000 externally, that means the balance is going to be transferred internally. Is that clear, please? We are done with requirements A. Yes, Charles.
Sir, I wanted to ask, the only reason why we used why we had to go and derive the 4.95 is because the selling price they gave us here is not for the internal customers, right?
We are
And
not
then
giving it. We are not
they
even
gave the
giving
selling
the.
price.
We are not even giving the internal selling price. And
Okay,
that's what
so
we want
the
to
only reason
calculate.
we went to go and find the internal selling price because of there is no one. The selling price here is not for the internal customers.
That's not the only reason. That is what the examiner said we should do.
Okay.
You understand?
Okay.
What the examiner say calculate the transfer price per unit, which ABBA division should quote. The transfer price is the internal selling price. So that is what the examiner says you even calculate. That's what I'm going to.
Okay,
in other words, if you are not to calculate, I would have done it now. The requirement is to calculate the transfer price. And the transfer price is the internal selling price or the internal purchase cost. So ABBA division, ABBA is selling. Okay, good. You ask this question now. So ABBA division, ABBA is the selling division. So that price is the selling price. So beta division, beta is the buying division. So that price is the purchase price, the internal purchase price. Is that clear, please?
Yes, sir.
Aha. So it's good that we ask questions. You are helping not only yourself, you are helping a lot of students. All right. We can go to requirements B now. And look at requirement B. This question, just by the wayside, it was first texted 2021 or so. It was repeated last night, or everything, no change. And good enough, my last diet class, we solved this question 100%. And I was telling them that, look, some of the questions might come to you that we solve in class. So leverage on that. Look at requirement B. Calculate the selling price per unit, which beta division should quote to external market. Look at it now. The attention is now on beta division. Calculate the selling price per unit, which beta division should quote to external market in order that its budgeted residual income target will be achieved based on the transfer price quotation. I need to even round up because you might have plans. Go for a break now. I will finish this stuff, finish question before I go, before we leave this class. God forgive me, sir. I want to go and pray, sir. Let's go to B now. We enable the whiteboard again. Let's see. I think this the whiteboard now. I'll come here, take this, take this. All right. So we want to determine the selling price for beta division, for external sales. The same approach we are going to take now to meet our residual income targets. Please, we have shared a new whiteboard. Requirement B is on beta division. You start with your solution. Start with your residual income. Please, what is the residual income for division beta? I think 500,000.
500,000.
Now add back notional interest.
Notional interest.
That is your capital employed multiplied by cost of capital.
Yeah.
What capital employed?
Capital employed is
3 million.
3 million
3 million multiplied by
times
10%.
10%. 300,000.
300,000.
So the profit should be 800,000.
800,000. Yeah.
That means beta division must be able to make 800,000
Aswaju,
profit.
your volume is low. Can you please increase it?
Really?
Can't hear you at all.
Please, let me hold on. Please confirm to me, others, that you can't hear me.
Sir, your volume is loud though. I can hear you.
I can hear you
I can
clearly,
hear
sir.
you very
So your
well.
volume is very
You
okay.
can hear now. It's
Very,
very
very
okay.
okay.
That
Hear you
is
very
the
well.
real comment. The problem is for your device.
Increase the volume of your device.
Because even my neighbor, they are like, what is happening in this man's house?
Hey,
Sir, that
sir,
it
sir,
has
chill,
been fixed
sir, chill,
already.
chill.
Sir.
No, that's no when somebody make a comment. That comments on the online, you must address it immediately. For my neighbor to be asking what is happening that you are making noise. That you are, I say, I'm doing my business, I'm doing my work now. So please look at your device because my volume is like 200% now, sir. There's the profits. Now, once you get the profit, add back divisional fees cost.
140.
140.
Mr. Aswaju, please, can you start from afresh, like this deep part? Because
Okay,
as
no,
at
but that
when
one
you
is fine.
started, I could not hear you. So
No, that's fine. That one is not a problem, sir. They are repeating it, not a problem.
thank you.
Oh no. Okay. I have to finish this thing quickly. Now, we want to get the selling price for our products per unit. If I'm able to get the total sales value, then I can get my selling price. For me to do this, I will start with the residual income target. For division ABA, residual income is 500,000. I'll pick that. Then I will now add back the notional interest. Notional interest is capital employed multiplied by the cost of capital. If you go to your division, beta division, please look at the question. The capital employed in beta division is 3 million. The cost of capital is 10%. Please compute 10% of 3 million. That will give you 300,000. That is the notional interest to be added back to your residual income. 300,000 plus 500,000 will give us 800,000. That is the profit. That is the profit the company, the division must achieve to meet its residual income targets. Once you get the profits, then go and pick the fixed cost. Add the fixed cost to the profit. That is where we are now. Divisional fixed cost for beta division is 140. 140 plus 800,000. What do you have?
940.
This 940 is the contribution. This is the contribution.
Yes.
When you are done, add your variable cost to get your sales value. Add your variable cost to it. Now, for division, for beta division, we are going to have two variable costs. For beta division, you know beta purchases components from ABBA. Hello?
Yes.
Let me go back to this because when the class is silent, look at it. Internal sales value. So ABBA division is 990. This internal sales. But to beta division, that becomes internal purchases. So if I get here now, I will now do like this. Internal purchases. Internal purchase. Or purchases. Beta division will purchase 200,000 components from ABBA division at a transfer price of 4.95 naira. That will give us 990. Then we now have further processing costs. Look at it. Hey, look at it. Look at it too. The components, when obtained from ABBA division, undergoes further processing at a cost of 450. That means if you receive 200 components from ABBA, you are going to further process it. Further processing costs. I will now come here. Further is further processing costs. Further processing costs. We are going to process 200,000 components at a cost of 4.50. Total amount
900,000.
These are the two variable costs. Now add back 940 plus 990 plus 900. That will give you
830,000.
That will give you 2,830,000. That is the sales value for beta division. Total sales value for beta division. Total sales value. And beta only make external sales. It doesn't make internal sales. All the components are sold to external customer. So this is the external sales value for beta. The other says, what is the selling price per unit for beta? Look at it. External selling price per unit for beta. External sales price per unit is equal to the total sales value. 2,830,000 multiplied by the quantity sold. The quantity sold is 200,000 units.
Multiply or
It's going
divide.
to,
Okay, divide.
of course, we are going to divide. This will give us how much, please?
14.15.
14.15. You are done with B.
Sir, are we not dividing it by 700,000?
Okay.
Yes, not 200.
Not 200.
Okay, no problem. First is
external customer.
Sales to external customer is 700,000 units now.
Oh, no. It's 200 because of the fact that that is what the 200 is the amount gotten from Alpha, and that was what was sold out.
all right. I've allowed all comment to run. Let me answer the question. Please do not divide by 700. That will be totally wrong. 700 units was the units sold by Abba division.
External
customer. Look at it. Abba division says 700,000 to external customer, not Beta division. Beta division only have 200,000 to sell to external customer. Is that clear, please?
Yes.
It is only 200,000 Beta has to sell to external customer, not 700. So please, because no one question are repeated. When students cannot attend the question, how come they cannot even answer this question to us? How can we repeat it? That's what they do. The only time is that we don't know when they are going to repeat it. So please, that's it. I don't know when they will repeat it. We are done with these requirements.
I showed you. I have a question.
Please go ahead.
Yes, please go back to the whiteboard. There's something. I wasn't inside. I went to help one of my neighbors. So there's something the figure of this 990. I remember we used the same figure in the A part. I don't know why it's resurfacing the
okay. To your question, in the A part, it was internal sales. To Alpha division, it was internal sales. To Beta division, it was internal purchases.
The 990?
Yes, of course.
Please, can you throw more light into that? I don't really understand it.
Why you say, okay.
Sorry.
You make it, what it says to you is purchase to another person now.
Yes.
If I come to your shop to buy goods, to you it's a sales. To me, what is it?
It's a purchase.
It's purchase now. So if you come here, Abba division is selling to Beta division. He sold 200,000 units to Beta division at 990,000. That means to Abba division, this is a revenue.
Okay.
So Beta division is a cost.
It's a cost, yes. Okay.
Is that clear, please?
It's clear. So okay. Maybe the question that maybe I'm not framing it very well, because are we now netting off this 990 when we get to part B, or we are adding it to this 940? I think that's what I.
Oh, okay. Another question now. Now we are trying to we had it anyway. We had it because we are trying to get the revenue. Look at it. Contribution plus variable cost will give me my revenue now. Is that not?
Yes.
If I want to get contribution is revenue minus variable cost.
Variable cost, yes.
So if I want to get revenue back, that will be revenue is equal to contribution plus variable cost. So we added all this together. 940 plus 990 plus 900. That gives us total sales value, total revenue. Is that clear, sir?
Okay. Oh yeah. Okay, sir. It's clear.
I was almost saying that. Are you the only neighbor? Why are you helping your neighbor now? Okay, let me just allow you to help your neighbor.
Bible says
Sorry,
we should
Mr. Siwaju.
Yes, sir.
Please, can I see the end of the solution?
The edge.
After the 2,830,000. The end, not the beginning.
This is the end now.
No, like for my own screen, so I can't see this other edge. Like this.
After the
Okay.
2,830,000.
There is nothing down there.
What? Nothing again now.
I showed you for my own end. Okay, yeah, it's clear now. All right, internal purchases. Is it
Okay,
further?
yeah, you are referring to this side.
Yes, this side. Is it further or processing? I didn't get that. Further, okay,
further processing cost. It's because of space.
Okay. Yes. So, okay, this 200 multiplied by 4.5 we got in part A.
Correct. Further
So
processing cost.
Yeah, give us this 900. That's okay. It's very clear now.
Oh yeah, the C part of the question.
Okay.
I need to even shut down, self. I can show. I can shut down now because that other one is just theory.
I believe let's see the A aspect of the stuff. We didn't get a good glance at it.
Are you fine now? I will still share with the group. Don't worry. Which one do you want to see now?
I think we don't need to copy since
The
he's sharing
A aspect. The A aspect.
And this is the A aspect now. This is the A we did now.
Please scroll up.
Let me even save and share. Yes, your question, no. Page.
What of the CPAS, sir?
Yeah, read the CPAS for us.
Explain why the transfer price calculated in A may lead to suboptimal decision.
Okay, I will explain briefly. But I will still share that everything remaining is just notes. I will share with you. Is that clear, please? I will explain briefly, but everything required now is just notes.
So you
questions,
and shared in the class or on the platform?
No, I will, of course, on the platform.
All right.
I'll share the platform, don't worry. After the class, because my system is actually low now. Now, the one is the price quoted, that transfer price might be suboptimal because that transfer price involves element of fixed cost.
Yeah, I got it. It's okay now. It's about those.
That is coming in our class though. Okay. That transfer price will be suboptimal because we have calculated the transfer price with fixed cost. Fixed cost is not relevant to decision making. That will affect our selling price. And it's going to affect the competitive strength of our company. When we calculated our transfer price in part A, we included 160,000 fixed cost. Because of the inclusion of fixed cost, we also include the profit margin, the markup of the profit. Now, when you include fixed cost in your cost calculation, it can create issue of suboptimality for you. Is that clear, please? Well, I'm going to share the notes so that you can look at it deeply. No, on this class, if I start that, I will spend another 30 minutes. I will share with you. There's even the D part. It was just missing here. If you look at the fiscal question you have, there's a D part. The D part says explain when it is appropriate to use. Okay, you can read the D part.
In what circumstances would a negotiated transfer price be used instead of a market-based price?
Thank you. There's a D part. It was an omission when I was trying to copy. The question says, in what circumstances will a negotiated transfer price be used instead of market transfer price? Please note, negotiated transfer price will be used where there is spare capacity. Please note, negotiated transfer price is most appropriate where there is a spare capacity. That is, the manufacturing division cannot sell all the products at the external market fully. The remaining outputs can be transferred internally at negotiated transfer price between the divisional managers.